Welcome back to the deep dive. If you've been keeping an eye on federal legislation, well, there's one bill really buzzing right now, Public Law 11921. Lots of people are calling it the One Big Beautiful Bill, or, the OBBB Act.
Yeah, the OBBB. Heard that a few times.
So our mission today isn't just to, read the law at you. We want to really break down the four core provisions that are about to hit your tax return. We're zeroing in on the big income tax relief and deduction parts signed back on July 4th, 2025. And they all kick in for the 2025 tax year.
Yeah, that's really key right off the bat. These aren't permanent changes. I mean, they're designed to give some immediate, tangible relief for working families, for seniors.
Yeah.
But all four big deductions we're talking about today, they're set to sunset, to expire, end of 2028.
Ah, okay, so just a 4-year window.
Exactly. You've got a 4-year window to, well, make the most of these benefits.
A 4-year window definitely creates some immediate pressure to figure out how these work. It also kind of makes you wonder, from a policy angle, why lump these four really different benefits tips, overtime, car loans, senior deductions? Why put them all in one temporary package? It feels less like some sweeping reform and more like, I don't know, 4 targeted stimulus shots.
Well, that's where the deep dive comes in, right?
Yeah.
Let's look at the first two. They're structurally pretty similar, and they focus on immediate earnings. We're talking Section 70201 and 70202, tips and overtime.
Okay.
And they actually share the same income phase-out rules on the high end, which, gives us a clue about who they're aimed at.
Okay, let's unpack this then. Starting with tips. Section 70201. For anyone in the service industry, this sounds like a huge deal. A new deduction for employees and self-employed folks, too, who get qualified tips customarily and regularly.
Right, and the maximum deduction here is, well, it's pretty generous, $25,000 a year.
Wow, okay.
To qualify, the tips have to be voluntary cash, charge tips, tip sharing, that kind of thing. But the really crucial part is transparency. They must be fully reported, on a W-2, at 1099, maybe Form 4137. The IRS definitely wants a paper trail for this.
$25,000 taken off your taxable income? That's massive, especially if you're relying heavily on gratuities. But, okay, there's always fine print, right? Who gets left out?
Yeah, there are exclusions. And they're specific, tying back to some older tax code ideas. First, if you're self-employed, the deduction can't be more than the net income you actually made from that tipping business.
Makes sense.
Second, and this is probably the bigger one, employees. If their employer is considered a specified service trade or business, an SSTB under Section 199A, they're completely excluded.
SSTB, okay, that's a bit technical. Can you break that down simply for us? Who does that usually cover? Who's not getting this tip deduction?
Sure. So think about professions where the main value is, like the person's skill or reputation, not really inventory or equipment.
Right.
Doctors, lawyers, financial services, consultants, athletes.
Okay.
And importantly, some highly skilled service providers too. Maybe massage therapists, certain salon workers. Basically, if you're, say, a waiter in a restaurant, you're generally in.
Right.
If you're a high-end financial advisor who happens to get a tip, you're probably out. So this distinction really narrows the deduction mostly to, well, lower capital service jobs.
Okay. That clarifies the target audience then, probably the typical restaurant or hospitality worker.
Yeah.
And the phase out, you mentioned that.
Right. The phase out for this one starts when your modified adjusted gross income, NGI, goes over $150,000 or $300,000 if you're filing jointly.
150K single, $300 K joint.
Yeah.
And MELR. Quickly, what's that again?
Yeah, MAGI. Modified adjusted gross income, it's pretty much your standard AGI, adjusted gross income, but you add back certain deductions or exclusions. It usually ends up being a little higher than your AGI. Congress uses it to try and make sure these benefits really hit working households, filtering out folks with maybe large tax-exempt income streams.
Got it. Okay, so let's move straight to the related one. Section 70202. No tax on overtime. This must affect millions of hourly workers.
Exactly. It's a parallel deduction.
Right.
And it applies very specifically to what they call qualified overtime compensation. So, when we talk about time and a half pay under the Fair Labor Standards Act, the FLSA, you get paid your regular rate plus half that rate again for the overtime hours. This deduction, it only applies to that extra half part.
Okay, so just the premium part of the pay. Can you give us a quick example just so that really
Absolutely. Let's say you make $20 an hour. Standard rate.
Yeah.
Your overtime rate is $30 an hour, time and a half.
Right.
That $10 difference, the extra half, that's what qualifies for this deduction. You'd still pay tax on the base, $20 for that hour, but the $10 premium, That's what this deduction targets.
Okay, crystal clear. And the max deduction here is $12,500 a year for individuals.
Doubling to $25,000 if you file jointly. And crucially, it shares that exact same high phase-out threshold we just talked about. Starts phasing out at $150K MAGI or $300 for joint filers.
$150K, $300K again.
Exactly. So these two provisions, tips and overtime, they're clearly meant to work together to boost take-home pay for, middle-income workers in hourly and service jobs. And really good feature is that you can take both of these, whether you itemize deductions or just take the standard deduction.
Right, so accessible either way. Okay, now, this is where you said it gets really interesting. We're shifting gears completely. Away from service income towards something that hits a major personal expense. Section 70203, the deduction for car loan interest.
Yeah, this one's, well, it's really different. An actual deduction for interest you pay on a loan to buy a qualified vehicle for personal use, mind you.
Okay.
But notice the immediate catch.
Yeah.
If you lease a car, you do not qualify. This is strictly for owning and financing.
Right, okay. Purchase loans only. The maximum deduction is set at $10,000 annually. That sounds like a pretty big help, but looking at the details here, the income rules seem really different. The AGI phase-out is much lower, isn't it?
You're absolutely right to spot that. Huge difference. The
Yeah.
phase-out here starts kicking in over $100,000 MAGI, or $200,000 for joint filers.
Wow, okay. $100K single, $200K joint. That's a full $50,000 lower than the rules for tips and overtime?
It is.
Why the difference? If the idea was helping working middle-class folks with the first two, why suddenly tighten the belt on the car deduction, hitting a lower income level? Is it just about saving the government money?
That's almost certainly the main reason. This deduction could potentially be very expensive for the Treasury, especially when you factor in that Made in America rule we'll get to, which kind of limits the supply.
Yeah.
So by lowering the AGI threshold, they're making sure the benefit is really focused on, let's say, upper middle income taxpayers and below, not extending quite as high up the scale.
Okay, that makes sense from a cost perspective. Let's nail down the rules for the vehicle and the loan itself. What makes the interest qualified?
All right, 4 key things. First, the loan has to start after December 34, 2024. So it's for future purchases.
Got it. New loans only.
Second, it has to be for buying a vehicle that's originally used by you, the taxpayer, meaning, used cars don't qualify. It has to be a new car purchase.
Oh, okay. New cars only. That's big.
Third, strictly personal use, not business or commercial. And fourth, the loan has to be secured by a lien on the car itself. Generally, if you refinance a loan that qualified initially, the interest on the refi is still eligible.
Okay. New car, personal use, secured loan, starting in 2025. And the definition of a qualified vehicle, that's got that domestic requirement baked right in, doesn't it?
It absolutely does. It has to be a car, minivan, van, SUV, pickup truck, or motorcycle. Gross vehicle weight under 14,000 pounds. Pretty standard stuff there.
Mm-hmm.
But the key policy part is, the vehicle must have had its final assembly done in the U.S.
Right.
This isn't just a tax break. It's clearly an industrial policy push, trying to boost U.S. auto manufacturing.
That's a fascinating thing to embed in a tax relief bill like this. So the IRS has to figure this out using the VIN, the vehicle identification number. You'll need that for your return.
Mm-hmm. You'll need the VIN, and it certainly creates a tight reporting loop, especially because the lenders, the banks, or credit unions, they also have to file information returns with the IRS showing the interest you paid.
Lots of tracking there.
Yeah, it means significant admin work probably, but the political goal seems pretty clear.
Okay. One more piece to this temporary puzzle. Let's move to Section 70103, which is aimed at supporting seniors.
Right. This one targets older Americans, folks who often rely on the standard deduction instead of itemizing.
Yeah.
What it does is introduce an additional standard deduction just for individuals age 65 or older.
An additional one. And the amount is pretty substantial when you add it up.
It really is. An eligible person gets an extra $6,000 deduction.
Wow.
And if you're married filing jointly and both spouses qualify, meaning both are 65 or older, that's $12,000 extra, added right on top of their regular standard deductions, like a bonus layer of tax relief.
So just to be clear, if they already get the existing smaller standard deduction bump for being over 65, this is another $6,000 on top of that.
Precisely, yes.
Yeah.
It's a full additional layer.
Okay. Now here's that pattern again. We have to talk about the income limit. This provision seems to have the lowest AGI phase out in the whole bill. It starts phasing out when AGI goes over just $75,000 or $150,000 for joint filers.
That's right. $75K single, $150K joint.
So why? Why pair the biggest potential dollar deduction, the $12,000 for a couple, with the absolute tightest income restrictions?
Well, again, it seems to come back to targeting. Some seniors might have pretty high retirement income, maybe large pensions, big 401k withdrawals, that kind of thing, leading to a higher AGI. This structure seems designed to give the maximum relief to seniors with lower retirement incomes. Those may be relying more heavily on Social Security and the standard deduction while making sure it phases out pretty quickly for higher income retirees.
So very targeted relief for lower to middle income seniors, and eligibility is just hitting age 65.
Yep, you just need to turn 65 on or before the last day of the tax year.
Okay. This has been a really helpful breakdown of these four temporary pieces in the 2025 Act. If we try to, connect the dots, look at the big picture, what really stands out about how these four kind of disconnected policies are structured together?
But what's striking is that Congress basically set up three different tiers for the benefit phase-outs.
Yeah.
Right? You've got the 150K level, the $100K level, and the 75K level. It looks like an attempt to target very specific socioeconomic groups with almost surgical precision. And the legal thread tying them all together, they're all temporary, only running through 2028. And they all require you to include your Social Security number, and if you're married, you generally need to file jointly to get the maximum benefit. Oh, and also, the IRS has acknowledged that signing this in July gives them and everyone a bit of a rush for 2025 taxes. So they've said they'll provide some transition relief for the reporting requirements for all four sections for that first year.
Okay, good to know about the transition relief. So, bottom line, what does this all really mean for people? This OBBB Act brings in some pretty big but very conditional tax shifts. If you've got tip or overtime income, if you're buying a new U.S.-assembled car, or if you're a senior taking the standard deduction, well, these provisions could mean immediate and significant tax savings for you.
Yeah, definitely.
But you absolutely have to meet those strict MAGI rules and all those hyper-specific definitions of what counts as qualifying income or, a qualifying vehicle.
Exactly. And that leads us right to maybe the biggest takeaway, which circles back to that 4-year limit, the temporary nature of all this. It raises a really interesting question about, well, behavior. If you know these big deductions are just going to vanish at the end of 2028, how does that change what you do today?
Ah, right.
Does that promise of, say, $10,000 in deductible car interest actually push you to buy that new car now, instead of maybe waiting until 2029 when the deduction's gone? This kind of sunset structure really forces immediate financial choices and the longer-term economic ripple effects of people pulling major purchases forward. Well, that remains to be seen. So here's something to think about. How does temporary tax policy designed to expire, actually change our long-term habits in the short run?